The Money Show.
Personal Finance with Warren Ingram.
To financial advisor Warren Ingram we go this evening. How do the world's wealthy invest, Warren, and what can we learn from them?
I love studying how people invest in the real world with real money, rather than just sort of dry academic studies. And for me, the most interesting ones are the people that have achieved financial success. And so looking at studies of them, especially over long periods of time, is always fascinating. Not from the point of view that we need to copy them exactly, because that's not possible. But there are some real big themes that we can follow. And for me, there are kind of three main themes. The one is, what's the mix of assets that they've got in their portfolio? What's the breakup between cash, bonds, property, shares? And then, secondly, how much effort do they put into trying to forecast the market and try and understand, where markets are going, when should they be buying, when should they be selling? And then lastly, how much effort they put into choosing shares, choosing bonds, choosing properties, in the kind of traditional, language for that is stock picking. And so for me, those are the three big themes. And when we look at the mix of assets in their investments, really interesting to note that they end up looking like an average balanced fund in South Africa. It's really, for me, was really interesting. Only about 2/3 of their investments are in shares, about 25% in government bonds and corporate bonds, and then the balance about 10% in cash. And if you look at an average balanced fund in South Africa, Bruce, over a 10 or 20 year period, that's how they invest their money. So interesting on that point, that I guess the world's wealthy are not that different from the rest of us, ordinary people out there. And I think the focus there is that they're trying to kind of have a long-term balanced mix of assets with a bias towards shares, which over long periods of time are really the asset type that will grow your money faster than inflation. And then you hold bonds and you hold cash. In most markets, except for last year, bonds and cash are the assets that give you a stabilizer against the roller coaster ride of shares. So for me, maybe what was surprising is that it's not different. It's not unique, that they're not kind of full up on strange structures or fancy guaranteed products or whatever. Fairly generic, fairly basic, fairly simple, and something all of us can emulate. And for me, that's very comforting, actually.
Yeah, absolutely. When it comes to institutional investing, lots of wealthy families may put some money aside, however, to be a bit more adventurous. They might go and invest in friends, fools and family businesses, for example. They may look for opportunities to, more often than not, really, because they're just curious as to whether people can grow businesses well and to advise on that. But we're not talking about that. We're not talking about the sort of venture capital side of things. We're talking about just traditional family money, people that would, families with decent amounts of wealth who look to the long term in markets. And this is what is so absolutely critical, isn't it? In terms of a lot of people go, well, I'm not going to get into markets right now. Markets right now are just so uncertain. I'm going to wait until things are certain. I'm going to wait till things look better. I'm going to wait till things are safer. And people, with long-term time horizons don't really care when they're investing in markets, how they care about the how, not the when.
Absolutely, and if you look at how frequently they actually buy or sell anything, only 1 in 2, so only half of them would do any transaction over a 12-month period. And then if they do a transaction, the average size of that transaction is less than 10% of their portfolios. Now, if we think how many times we get asked the question about people saying, I'm really worried about markets. Shouldn't I just sell all my shares? In other words, now they're 100% of their portfolio is what they're looking at. Moving 100% of my shares into cash, or 100% of my bonds, or the other way around. I think the markets are really offering great value. Shouldn't we go from 100% cash to 100% in shares again? And the world's wealthy just simply don't do it. They're not active. They're in fact very relaxed, very calm. They might be panicking inside, but they're not reflecting that in the way that they're managing their money. They're allowing the portfolio that they've got to do its job, which is generate long-term growth, and they've kind of walked away from this idea of market timing. And I think it's a key point. We need to be humble enough as investors, and I'm saying it, for private and professional investors alike, is we need to be humble enough to know that in most conditions, we actually don't know what's going to happen tomorrow. Forget about 3 or 6 months' time. And when you don't know what to do, develop a long-term strategy, have a nice mix of assets, and then stick to that strategy, especially when times get rocky and the news gets scary, and you hear about banks falling over in America and getting forced marriages of banks in Switzerland. All of that stuff is frightening. That's not a reason to sell. That's maybe the time to double down on your strategy and stay invested. And if you've got a bit of extra cash, keep allocating it to that mix. And I think that's what they're doing. They're just simply not trading in any conditions, and most especially volatile conditions. So I think for me, very, very interesting to see that, very comforting again, because probably something we've said thousands of times by now without resorting to hyperbole, but we said that on the show so many times, don't trade, don't panic. And now looking at the world's wealthy, the ones that have actually achieved success with their money over long periods of time, that's exactly what they're doing. So I think it's something we should be listening to and paying more attention to.
When it comes to investing, I mean, the question I'm asked most on social media platforms, people email me, they say, I want to learn to trade because I want to invest. And those are two contrary ideas, and I immediately refer them to How to Make Your First Million, which is a book that Warren Ingram wrote, which says, don't trade, don't be a twit, invest. But what's interesting about the data that's come out of Vanguard is the vast majority of people who invest use unit trusts. They use index funds. Very few hold individual shares, and probably those that hold individual shares are those that have got some level of experience or some level of insight, some level of wisdom built up over a period of time that gives them the confidence to manage at least part of their money themselves.
Absolutely. And I think, if we had to look at the number of people, investing in shares as opposed to the size of assets, but just the number of people, there probably are many thousands of individuals who buy and sell shares. But if you look at where the volume of money where's the sheer weight of assets, it's actually sitting in unit trusts. And I thought that was really fascinating. So only a third of the world's wealthy own individual shares. The balance of their money is sitting in unit trusts. What it tells you is they're not fooling themselves that they know better than the market. They're simply happy to buy unit trusts and let the fund managers do their job. And for me, that's really important. And I suspect, I don't have the data, even in that Vanguard study, which is what we're looking at here. I couldn't find whether those individual shares that they own might just be, the result of share options, for example. A lot of people will work for a company for a long period of time, build up, shares that they're given as part of their remuneration package, and that might be a big chunk of the wealth creation that they've had and why they've got individual shares. But certainly they're rotating out of those individual shares into unit trusts, and I think that's another pointer. I can't stand seeing all the ads on social media where you see trading sites, saying we'll teach you how to trade, whether it be shares or foreign exchange or cryptos, etc. And to me, all that's doing is generating transaction revenue. In other words, they want to make money off you buying or selling. That's why they're happy to advertise. But just understand what you're doing is you're converting your long-term hard-earned savings into their bonuses at the end of the month or the year. You're not generating wealth for yourself. Trading simply just doesn't make money for most people in most conditions. It's really not a good way to make money. And there's a reason that Warren Buffett and Charlie Munger are really famous and traders are not. And it's because they don't make money over periods of time. They're the ones that are lucky every now and then, but the bulk of them aren't. What was really, really, really surprising for me was, and one I suspect will change over time.
Let's pause on that thought for a moment, because I just want to look at this individual shares thing, because you're going to move on to passive investing in just a moment. I suspect, because you've got your passive investing voice on, and because you have that. Investing in individual shares, again, just because you're investing in individual shares doesn't mean that you're sitting at home in your underpants on your weekends trading shares or putting positions in on shares. So often, wealthy people who have got unit trust portfolios can also run private client portfolios. They can also have a handful of shares that have got a level of oversight. They've got a stockbroker's account. They consult a stockbroker. They're not doing this off their own bat completely. They may very well be taking advice on those trades when and very occasionally they make them, whether it is to add to a holding or release a holding, for example.
True. And I think, very often it might be very specific situations where they own shares, where they've got a long history with a particular company, or they come from a particular sector of the industry. Now, let's just say someone works in mining and they know mining very well, and they respect management of one or two mining houses. They might buy mines very specifically then, or airlines, or whatever it is, whatever the speciality is that they've got. You might find that they use their deep knowledge in a particular area then to take advantage of that deep knowledge. But I can tell you what they're certainly not doing is they're not going to FinTwitter and looking at someone who started writing articles last week and hasn't got any money and a big following and listening to those people, because those are the ones that have cost investors most of their savings in the last 2 or 3 years. When you find some influencer targeting Warren Buffett and saying, what an idiot he is and what a dinosaur he is, and then you watch how that influencer is busy blowing up his portfolio now, you just realize, large Twitter followings or large social media followings doesn't equate to investment knowledge. It just means you're good at taking pictures and saying controversial nonsense. It doesn't mean that you know what you're doing. And I think that's the point.
How do you feel about that, Warren? Anyway, let's not go there, because otherwise we will be here till midnight. Talk to me about passive investing then. You'll put back your passive investing voice, and take me through this idea of passive investing and the big shift to passive investing. It's been a trend all over the world in many, many places. We as South Africans have been less inclined, but I think we're gradually more inclined towards so-called passive investing. I say so-called passive investing because you do still have to make decisions about where you put your passive investment. But talk to me about the trend.
Well, Bruce, how's that for my passive investing? No.
That's just your fake.
So very quickly, passive investing is you buy let's say in South Africa, you buy the top 40 or the top 50 shares on the stock exchange. So you're not applying any thought to what to buy or what to sell. You're simply buying one investment that mechanically tracks the biggest companies on the JSE, and you can find these all around the world. Whether it be in the US or simply the entire world stock market, and passive because no one's being paid to second guess what's going on. They're simply being paid to implement a mechanical calculation and then put a portfolio together that you can then buy. I think it's a very good way of investing. Interesting to note that I think in the US it's now just passive investing has just overtaken active investing. Active investing, just to break that, is then paying fund managers or stockbrokers to forecast where they think the world or the stock markets are going, and then they buy and sell individual shares to try and beat the stock market. And for a long time, active investing was the only game in town. But over the last while, last 2 or 3 decades, active investing has been growing incredibly quickly. And I think now I'm right in saying in the US that it's now slightly bigger than active investing. But when we look at the world's wealthy, interesting to note that more than 75% of their investments are still allocated to active funds. I was sitting down, so I didn't fall over when I read that, and I found that deeply surprising. I can't tell you why. I think it might be historical that they've had money in these funds for a long time. As we said, they don't like to trade. So what they hold, if they're comfortable with the holding, they're not going to sell. And I suspect that's part of the reason that active investing is still such a big chunk of their assets. But for those of us who are not sitting in that position, I would suggest maybe still a blend. That you don't just have one or the other. Don't be too absolute in your investment strategy. It's okay to hold some index and some active investments together, and nothing wrong with that. Just don't chop and change and trade them, I think, is maybe the more important point. And maybe the biggest point out of all of this is number one, you need to invest. You can't be sitting on the sidelines being fearful about stock markets rising and falling. And I think that's probably the most powerful message. And actually spending too much time and effort and getting into analysis paralysis about exactly what to buy doesn't make sense to me. I think that's maybe what the other thing I'm learning from the world's wealthy is that they get in, they stay invested. Sure, they might not be in the absolute lowest cost, most efficient portfolio, and they can't be if they've got most of their money in active funds, but they're okay to hold those, and that they allow their capital to keep growing and to keep compounding.
Fabulous, Warren Ingram. Thank you. In a moment, a question from Greg. Greg says he's got a decent sum of money sitting in a bank account overseas. He's quite worried about it because of big bank failures. What other ways can he use to store his cash? What a lovely problem to have, Greg. That with Warren in a moment.
The Money Show.
Personal Finance with Warren Ingram.
Warren Ingram, Greg's problem. He's got cash sitting in a bank account now. He's worried about banks falling over, which is one of the reasons why there are runs on banks around the world. People are worried about banks falling over. But as you say, it's never a good thing to keep money in the bank for too long. We need to be finding accessible, more sensible ways of storing our cash so that in a month or two we can get hold of our money without risking the capital should the unthinkable happen, and that is a bank failure.
Absolutely. And it's so interesting to see, and such a credit to the Reserve Bank in South Africa that, we've been through two rather significant financial sector events around the world, and South Africa comes out of it most of the time, very unscathed. And that's because we're so well regulated and have such a good regulator around this. But when you're sitting with deposits in a bank account, it's important to know that if you've got money in a money market account, at a bank or in a fixed deposit at a bank, those are your assets, but they also sit on the balance sheet of the bank. And if the bank hits the wall, you might lose those deposits. And in South Africa, the first 100,000 rand of your cash that's on deposit would be protected by a Reserve Bank guarantee. And in the US, it's $250,000. Switzerland, about 100,000 francs. So many of the big central banks or governments will underwrite some of the deposit, but important to know that your assets then form part of their balance sheet. And if you want to prevent that, then you need to look at something, for example, very simple, like a money market unit trust. So different to a money market account at a bank. It's a money market unit trust. And the reason that's very different is because the assets are only owned by you as an investor in that money market unit trust and all the other investors in that unit trust. Even if the money market unit trust was launched by a bank, all they've got is the right to earn some fees on that account. They don't have rights to those assets. They can manage the assets and they can try and give you a return. But if they hit the wall, your assets are safe. And I think that's an important thing if you are worried about banks falling over. And as you said, Bruce, at the start, don't sit with too much cash for too long. That's a great way to kind of stagnate and destroy the buying power of your money. But if you legitimately need to hold cash, and you are worried, then make sure you stay below those guaranteed limits of the Reserve Bank guarantees wherever your money is, and then secondly, potentially hold that cash in one or two money market unit trusts, and always, that's what the SVB people need to learn as well, is don't be greedy, don't go for the very highest interest rates offered by banks because maybe they're taking a bit too much risk that you can't see. So rather err on the side of caution and be safe with your money and spread it if you need to. I feel that's probably the best answer for Greg.
Thank you, Warren Ingram, especially with inflation here. Inflation running at 7% in the US, around 6.9%. In the UK, back in double digits once again. And in the European Union, different inflation levels all over the place, but certainly elevated inflation. The longer you keep your money in a bank account, the quicker it loses its buying power, it loses value. It's corroded by inflation. You need to be looking for the best possible returns. If you want accessibility to that cash, of course, into those money market accounts, as Warren suggests. That's a wrap for the Money Show for this evening. Thank you very much for joining us tonight. Warren Ingram, thank you for your contribution as always.